Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us this afternoon, we have Kevin Davitt, head of index options content at Nasdaq, as well as Mike Khouw, CNBC contributor and YieldMax strategist at YieldMax ETFs. We're here to discuss the market's collective expectations based on what the options market is implying. By monitoring these shifts, options traders can adjust their strategies, hedging risks, speculating on price moves, or seeking to capitalize on changing sentiment, making future volatility not just a number, but also a representation of both risk and opportunity. It's great to see the both of you. As always, welcome to Trade Talks. Kevin, we're going to kick it off with you. I can't believe I'm saying this, but we're back to school heading in September, and we know that October can mean higher realized volatility. Has there been any derivative activity predicated on that potential pickup in vol?
Well, first of all, you're right about that. I dropped my kid off for the first day of fifth grade this morning, and pretty much right on cue. Well, just to be clear, anytime we talk about seasonality, we have to be careful, because just because something happened in the past, whether that was September or October, doesn't mean we expect that in the future. But it's interesting in the sense that essentially right on cue, realized volatility at the index level, when we look at short-term measures, things like 20 and 30-day, have started inching higher in August. And I would kind of cite the last jobs data as that catalyst. So giving that a little bit of color, Nasdaq 100, 20 and 30-day historical vol moved from below 10%, which is unusually low, up to about the mid-teens. Now, to be clear there, the mid-teens is still fairly low. It's just closer to the longer-term average. Now, we have a visual that shows monthly Nasdaq 100 price returns. It goes back essentially a decade. And what I've done is highlight the September returns in purple. And you can see that in 4 out of the past 5 Septembers, the index has stumbled. And there was a really significant sell-off in September of 2022. Now, in a potentially related vein, and to answer your question, what we've observed is what I might characterize as a steeper than expected term structure of volatility at the index level of late. I'd like to translate that for people that don't think about index options all the time. So right now, we have relatively low realized vol in the Nasdaq 100, and 1 month forward at the money volatility is trading around 15.5, 16%. What's interesting is how quickly that at the money implied volatility moves higher as you look out in time. So to illustrate that, the December at the money vol is closer to 19%. If you look out to early next year, implied vols are even higher. So in short, there's a greater than normal premium for both time and downside being priced into the Nasdaq 100 index options market right now. I think you could construe that as the market saying, not particularly worried right now, but there's some potential concern out in time, and we will see if that's warranted with higher realized volatility in the future.
Yeah. And Mike, I'd like to get your thoughts as well on seasonal volatility, including some of the fundamental factors that you'll be looking for.
Yeah, I mean, so kind of to Kevin's point here, one of the tricky things when you take a look at volatility seasonality is that large numbers tend to have a bigger impact on an average than small ones do, because volatility has a lower bound, but we've seen index volatility get up to 80% or so. So if the prevailing level of volatility, let's just say, is 15%, and then you periodically throw in a really big number, it has a tendency to throw off the averages. And I think that's one of the things that Kevin was talking about. It's interesting if we take a look at index volatility and we compare short-term implieds in NASDAQ and other indices and look back a year ago. And what you'll see is that the nearest term volatility is actually lower now than it was this time last year. And if you go out, call it 9 months in implied volatility space, it's actually substantially higher than it was. And that's interesting to me, because what did we have going on last year? We were going into a presidential election, and we have to assume that the market was going to be digesting whatever the outcome of that election was. So it is kind of interesting to see that the options market is actually expecting more choppiness, when we take a look at the back half of this year and early next year than it did this time last year. So those are some pretty big catalysts, and it seems like there are some even bigger ones in the offing, at least as far as options markets are concerned.
Yeah. And Kevin, it's interesting. You brought up a breadth indicator that I thought was really interesting about a couple weeks ago, and you use that in addition to other technical factors to determine overbought and oversold conditions. Quickly review what you're looking at, and is there any update to what you're seeing in the chart now?
Sure, you're, pardon me. On one of my last spots on Trade Talks, I did highlight some of the breadth indicators specific to the Nasdaq 100. If we talk about what we were looking at here and now, I'd point out that 62% of the index constituents are higher year to date. Now, framing that a bit, that number has vacillated from as high as 71 to the low 50s. If we take that kind of half a step further, we could use some technical indicators, like you mentioned, the 50-day moving average or the 200-day moving average, and see how many of the index constituents are trading above or below those potentially short and longer term support levels. So I have another visual here that plots pretty much just that, the number of NASDAQ 100 components above those respective levels over the course of this year. In general, I think you could say that breadth of late has been narrowing since late July. The number of index components above both their 50 and 200-day measures has declined demonstrably after that August 1st unemployment report. Now, my personal belief in the moment is that the Nvidia numbers later this week may be a catalyst for whether a chart like this and breadth measures expand or contract in the next few weeks. And we're going to have to wait until Wednesday for that report.
Yeah, that's a great point that you make. And of course, Kevin, it's going to get considerable attention. So what's the option market forecasting at the stock level, and what's the knock-on effect in the Nasdaq 100 volatility market?
So I assume we're talking about Nvidia, and while it's not quite the same kind of zeitgeist of a year or so ago where people were getting together at bars to watch coverage of their numbers, it's not that far off either, or at least I'm not invited to the bar for this earnings report. If we look at the money Nvidia straddle that expires later this week, the market's pricing in an up-down range of right around 6%. Now, if we put that in dollar terms, which is easier to consider, that's an expected up-down range of about $11 in $180 stock. That 6% number is very much in line with what the option market has priced specific to Nvidia over a 2-year look back. Now, the average realized move over the same time frame is slightly over 8%. And that might be counterintuitive, but it goes to Mike's earlier point of that measure is skewed by something close to a 17% move on a realized basis for Nvidia in February of 2024. So those big numbers can skew that average higher. Now, at the index level, there is more demand for downside protection here and now relative to upside exposure than we've seen in a while. That might not be directly attributable to Nvidia and their report, but they have arguably become kind of like a clearinghouse for AI-related investment. Again, specific to NDX options, we're on pace for another record month in terms of volumes. It is not unusual these days to see 100,000 options trading a day. Maybe on face, that doesn't sound like a whole lot to your audience, but if you consider the index is 40 times the size of the Qs, that NDX volume translates into roughly 4 million QQQ options a day, but this product is cash settled and European styled. Obviously, we're excited about that growth, and I'll come back on here and talk about what shakes out after Nvidia's numbers and at the index level looking forward.
Yeah, we certainly look forward to that, Mike. I want to ask you a question regarding options-based strategies in the ETF wrapper, because it's certainly gaining momentum. What's driving that growth, and what types of strategies are advisors and investors gravitating to? And adding on to that, what differentiates the methodologies from one issuer to the other?
Yeah, so it certainly has picked up a considerable amount. I mean, there's probably about 150 billion or so as I speak to you now in options-based ETFs. That may sound like a lot. It isn't when you think about the size and scope of the ETF market generally, which is, in the $14 to $15 trillion range, if you can believe that. And I think what's interesting about this is that if we take a look at the history, Kevin was just talking about the growth in options volumes in NDX. And by the way, for people who are looking at, doing things at home, I happen to personally prefer European settled, cash settled options because, there's a lot of complexity that gets introduced when you have to deal with potential assignment and exercise risk into the underlying asset, sometimes intentional, sometimes not, but that's probably a conversation for another day. So I think really the fact is that options volumes have exploded over the course of the last 20 years, and assets that are managed in ETF wrappers and other types of funds that focus on options-based strategies hasn't kept pace with that growth. So, to me, I think this is just early days. I mean, there are a couple of reasons for this. Putting options into 40 Act regulated wrappers is a non-trivial exercise. There is some complexity, regulatory complexity with that. There's tax optimization that has to go into it. But, I think now that, we've seen several managers kind of figure out how to do that, I expect this to really explode. So in terms of strategy differences, obviously one of the key areas where you're seeing a lot of options volume outside of the fund space is in zero DTE. So you do see some managers who are focusing on, say, for example, recurrently selling zero DTE options to collect premium. There are, several others, including us, who focus on slightly longer dated options than that. But I will say that I think this is really where most of the attention is being focused on strategies that look to sell options regularly, collect a little bit of volatility risk premium, and pay regular distributions. I think this is one of the reasons why people are interested in it. People have always been interested in options. They're interested in them because they have nonlinear payoffs. They like to use them for hedging. But, I don't know that hedging is the vehicle that would normally be in an ETF wrapper. So it's usually income-based strategies that people are really focusing on right now, I think.
And to wrap up, Mike, do you think the introduction of a wider array of options, contracts, and products impact the options and volatility markets? And how should advisors and investors be thinking about their portfolios in that context?
Yeah, I mean, I think the addition of additional products, of course, is always going to, the more there is on the menu, I think that's generally going to be a good thing. It can be a little bit overwhelming. One of the things that the options market has done more recently, which I appreciate, is they've kind of been focusing attention on products that maybe they had weeklies and then the volume drifts off a little bit. And then they said, okay, well, maybe we won't list weeklies on this. You can't just have a proliferation of contracts that's a one-way street. There's actually technological challenges for market participants who are just trying to deal with the fire hose of data that's coming out with all of these new products. But in general, I think it's all positive. We want to have more options and more flexibility in the way that we invest, and we're certainly seeing that. And if people find difficulty managing these things themselves, now we're seeing more products that trade like stocks that can implement these strategies for them. And then if they, ramp up their skills, their ability, their knowledge, then they can start to implement them for themselves on other underlying assets as well.
All right. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.